So, hey everyone, thanks for joining us. My name is Corey Henn. I'm an associate at Concrete Ventures. We are a $17 million Atlantic Canadian pre-seed fund focused on finding great ideas and founders who are looking to build massively scalable businesses here in Atlantic Canada. One of our core values is to have an impact on the broader startup community outside of our own portfolio, which is why we love to partner with folks like Mike and Visible to put on these webinars for everyone. So today we're excited to have Mike from Visible. He's the CEO of the company, to come here and do a talk about creating FOMO in your fundraise. So for those of you thinking about raising capital, this is shaping up to be a great session. You can ask questions at any time with the Q&A feature during the webinar. And if Mike has time, he'll either answer them live or following the session. And with that, I'll hand it over to you, Mike.
Awesome. Corey, thanks so much for having me. Great to meet everyone virtually. Let me get over to Chrome here. As Corey mentioned, my name is Mike Preuss. I'm the founder of Visible. I started the company back in 2014, so I've been doing this for a little bit now. If anyone has a question that I don't get to, or you just want to say hi or whatever, please either connect with me on Twitter or just email me. It's mike@visible.vc. We host a lot of webinars and do a lot of events, mostly around investor updates and reporting for the longest time. And today is kind of like the first version we're doing of this fundraising series. So like, I would love to hear from you after, like, if you liked it, if you didn't like it, what you would love to see different, like both mixture of positive and negative feedback. I think would be great. Just a little bit about Visible. We help founders update their investors, track their KPIs, and manage a fundraising process. We have over 3,500 customers now across the world, 6 different continents, and growing rapidly. Concrete's one of our customers on our investor platform. They've been super amazing to work with, and just really excited to get into the content today. And again, if you have any questions, let me know. We are sending this deck out, so I'll send the PDF version out as well as a Google Slide version. There is some like rich media in here that you can listen to and play at your leisure. But yeah, let's get started. Quick disclaimer, I think what I'm about to share, these things are guide rails. Like every business is different, every market's different, even the timing is different, right? So these are, I would say, rules, but there's always exceptions, and everyone's a little bit different. But really, I think the goal for today is just to provide some tactical templates that you can use, some frameworks and resources for you to apply and to try to your own business. And just to kind of go over what we're going to cover, understanding the rules of the game, as I like to speak, like how venture investors think and work, so that you can have a better chance of fundraising, how to find the right investors for your business, really get into some power user type stuff on automating and personalizing a fundraising pipeline, a template you can use to reach out cold and use either for blurbs and intros, and then finally, like how to use investor updates to create momentum as well. Great. So one of the first things I want to talk about is power law and why this matters for founders and how you should think about using it to your own advantage when you're fundraising. And some of the things you might have heard if you already fundraise or are fundraising, or you probably will hear, I hear these all the time, is a venture investor might reject you, say, hey, we just think the market's too small. It's not a big enough market. Or you might hear them say like, hey, can you walk me through how this gets to $1 billion in revenue in the next 5 years or 10 years. Or you might do a great pitch like, awesome, this is great, like, but how does it get bigger, right? One of the things you'll constantly kind of teeter on is this idea of like rubber meets the road, very tactical, but then also like, great, how does this get bigger? And it's like frustrating to hear that, right? You're like, hey, I've built this amazing business, like, and now you're forcing me to kind of really think big. But if you kind of break it down, and again, all of the blue links here, you guys will be able to click and kind of see sources and stuff like that I've curated, but it's power law. And really, if you know about this, great. Hopefully I can share some interesting things you might not have heard before. But the reality is that like 6% of startups make up 60% of the returns. So a very small few companies every single year really make up a bulk of the returns in venture. And folks that invest in funds like Concrete Ventures or firms or venture funds, limited partners, they expect big returns, right? They're investing in venture for a couple different reasons. One is diversification, and then the other is that they expect to get high returns outside of the market. because they could put their money anywhere, right? They can put it in real estate, publicly traded equities, in the stock market, bonds. And so they're going to expect to get a differentiated return, especially since venture is incredibly illiquid. So quick example, if you have a $100 million venture fund, and let's just say on average, they own 10% across all of their companies at exit, that means that to return a 3 to 5x fund, they need to have $3 to $5 billion of cumulative exits across the portfolio company. So the bar is incredibly high. And so I think it's really important to frame yourself when you're pitching investors, especially funds and firms, that they need basically to operate, your company needs to operate at a big market with a big vision. This is something interesting I saw too, just more related to the times more than anything. Like, especially if you're on Twitter reading about, companies raising at insane valuations and doing it incredibly fast, is, a couple of years ago, seed rounds used to be $2 million valuation. And when they were that low, a single unicorn could return a seed fund. But now when you see higher valuations, investors need even higher exits, right? Because you're going to own less of the company. And so the pressure is even higher now to operate faster in bigger markets. And so I think just one thing to keep in mind as you're pitching investors is how can you convey with confidence a big vision, and we're going to get into that some of that later. One kind of, sorry, I'm all over the place in my mouse here. One really interesting thing, by the way, I think is like market sizing is really hard. This is Uber's original pitch deck. And they said the overall taxi market at the time was $4.2 billion. And if you look over on the right, they said the best case scenario was that they would become a market leader. Like, this is like their best case scenario. Market leader, $1 billion in yearly revenue. I pulled the data for 2020. Uber's doing $11 billion in net revenue. So they're bigger than the entire market that they try to forecast, and well bigger than the best case scenario. So market sizing is incredibly hard, especially when you're dealing with new markets, maybe that don't even exist. And one of the things you can download from us, by the way, is our total addressable market template. It's just like a Google sheet. You can plug in some inputs and it'll drive like what percent of the market do we need to capture at what price point to get to a certain size business. So this is definitely one of our more popular templates. I'd encourage you guys to check it out, use it. Works well, but it could help you just get started with that and asking that question of like, how big of an opportunity, is this? Great. So now let's get into kicking off your fundraise. A lot of the material we're about to cover is some stuff we've recently learned. So we interviewed a lot of early stage investors over the past 2 months for our Founders Forward podcast that we put on. And we were just asking them questions about fundraising mechanics, expectations, timing. And the first thing that I think is super helpful is just framing how much time fundraising actually takes. I think we as founders under-index the amount of time and work it is. And so there's like this interesting just 1-3-1 framework, which is how long it will take. Again, these are probably rules, not the exception. There's some companies that'll take longer, some take shorter, but in general, plan for 5 months, if you're doing a seed raise. And that's 1 month of prep work. That's finding the right investors, setting up your pipeline, building out your deck and your story, practicing, getting meetings set. Then you have the 3 months of fundraising, pitching, follow-ups, additional meetings, hopefully a term sheet or term sheets. And then I think we always forget about, like, you get the signed term sheet, which is great. And then you still got at least 30 days probably to close because you have legal. You're going to be chasing signatures from current investors, also potential ones. And then like any final diligence that might happen. So we found that like, hey, 5 months is kind of the norm or median of how long it's going to take you to do a seed round. So I think that's helpful to think about, especially, when you are doing this, it's a big time commitment and takes you away from other aspects of the business, which can hurt the business too, which can hurt your fundraising. So I think it's always helpful to think about the time it takes in effort. This is a huge one. Just like, and we'll talk a lot about B2B enterprise SaaS and how it's very similar to investor relationships, but it's all about the ideal customer profile or ideal investor profile is what we call it. Like, spend time finding the right investors, because it's really two things. One is spending time on the wrong investors can be really detrimental, right? If, for example, I'm in Chicago, if I'm pitching concrete ventures, it's a waste of my time and it's a waste of Corey's time. because we're doing Atlantic companies, right? In Canada, he's like, hey, we're not even close to being in the right wheelhouse for you. Also can make you look like an amateur. So when we think about finding the right investors for your business, we'll set up a little framework for you guys and share some things here. This is Jenny Fielding. She's got an awesome slide deck on setting up your investor pipeline. We've also built it in Visible, so I can share that. But what she found, and she does this, 30% of her time, she said, lack of a great framework makes fundraising 10 times harder. 95% of founders don't have an investor pipeline document. Like, what investors are you talking to? Going back to the time, like you'll spend way more time than you ever imagined fundraising over the life of your company. And then one other tactical thing is, when you build out this document, build for the current stage, but also one from now, because you might hear from investors like, hey, we're a little early. You're a little early for us. So can you start nurturing those potential investors now for the next round? And so if you click that link, you can check it out, but we'll also cover how you can do this in Visible and just some other information. So what should you check, right, about these potential investors? There's some basic name, rank, serial number type stuff, like what's the name of the fund? Who are the investors, right? Because each fund, each partner might even specialize, like, hey, this partner specializes in AI versus biotech versus what have you. So, who might be the right partner at the fund for you to build a relationship with? What's the fund size? Fund size is incredibly important, right? $17 million fund, Concrete Ventures, Corey mentioned, they're probably going to do early stage investing. So if you're trying to raise a $10 million round and need them to write a $5 million check, probably not the right fund. And so it helps you just understand what stages funds are investing at if you know their fund size. One thing that's not in here, I think that's also useful, is where are they in the life cycle of the fund? Is this a newly raised fund in the last 12 months? Or is this 4 or 5 years old at this point and they haven't raised an additional fund? If it's someone that's early on, they're probably going to move quick, want to deploy capital, and you're going to be more eager to move quickly. And at the later end of their life cycle as a fund, they might be more selective, not have a lot of cash left. So I think that's helpful to know as well. Understanding if a fund leads or doesn't lead deals is highly important too. Not so much anymore, but still important, right? Because you might be talking to people that only co-invest, like, would you have a lead yet? And so checking if someone leads or not is super important. Theme, hey, we do SaaS companies, enterprise SaaS companies versus we're in life sciences, right? You want to make sure you're pitching funds that are in the same theme or space that you're in, again, or else you could be wasting time. Relevant portfolio companies, I think, is a great way to help find potential investors. Like, who are similar companies, maybe similar business model or stage or someone in a similar space to us, and use them to find who invested in them, but not direct competitors, right? No fund will invest in a direct competitor. Conflict of interest, you're going to give sensitive data to them, they can flip over to those competitors. I think this is something, especially first-time founders make the mistake, is like, oh, they invested in a very similar company, so they're going to be interested in what we're doing. Well, the venture investor, again, big market, winner take all type mentality, they're less likely to invest in a direct competitor. Last contact, like, when did we last talk to them? Who should we contact at the fund, going to that investor name? And then who can intro? This is like maybe the most important piece here. Like, who can provide us a warm intro to that fund or to that investor? One other thing that, and I'll show you this in Visible here, is we automate a lot of this for you. So we give you a pipeline when you sign up. We'll give all of those fields for you as a default way for you to get started. And we'll even give you some ways to search and find investors. So going to just Visible quickly. Again, this is kind of the first time I've done this, so would love to hear what you guys think of this. But I'm going to go to, I'm actually just going to create a new fundraising pipeline for, let me get rid of Zapier here, for everyone today. And I'll just call this my seed and raising, let's just say $2 million. So I already got my investor pipeline set up here. I got some different stages. And if I go and I click research, I can start entering in different information about funds, concrete, just stick with that theme. And I can put in contacts. We have a bunch of other things. I got notes here, and you can quickly set up your fundraising pipeline. The other thing we let you do is, I think that, fundraising is highly personal, and, fit it to your workflow. Like, what workflow do you want? Are there certain properties that you want to track about investors? Are there certain stages that matter or don't matter to you? And so personalize it to your workflow. And again, with Visible, if I come up here, I can click manage stages. This is where I can put in a customized stage. So maybe like looking for intro is a stage, and I'm going to put that between research and contacted, for example. So we let you customize the different stages as well as the different properties you track. Oops, excuse me. So maybe you want to track, let me go to manage custom properties here. You can see I have like some different options here. So let's just say LinkedIn URL. I can come here and put in this as a URL, but we let you set up different fields like drop downs, selects, currencies, things like that. So we let you customize fields that matter for you in your fundraise and bring those all into the fundraising experience within Visible. So make it personalized, but again, going to be really important for you to set up kind of a structured way of how you think about what funds to find and move them through your pipeline. And great, like I got this pipeline set up. It's kind of blank, right? Like shit, how do I fill this thing? Couple of free resources just to off the start. One is we built one. It was like a side project of mine last summer, and maybe even before that, where I was just taking free databases online and merging them and deduping all the data and just using that for our customers. And now it's become a proper database. There's some other ones here you guys can check out. VC funds under $200 million. Those are all great for early stage investing. You can check that link out, and it's a huge list. Crunchbase, another good free resource. If anyone's in Europe here, there's investors in Europe. But we try to take all of that data and dedupe it into our database. So if you open Visible Connect here, you can search by stage. So show me all seed investors. Maybe I want to do B2B and then a particular geography, right? Maybe I want to look for Canada. Great. Here's 14 folks that we found that fit those criteria. Anyone here that you see with a check mark, this actually means that they gave us that data. So we have a whole team that goes out and tries to verify data from investors that can put in things like, if I click into Expo here, you can see where they're based, the check sizes they typically write. So we let you filter by this too. Like, hey, are they writing check sizes that we need? We'll show you their different themes, the geographies they'll invest in, any of their recent investments as well as the sweet spot check size. So like, hey, they typically write $1 million checks. So this is like a free resource. Anyone's welcome to use it. The beauty of this as well is that it actually integrates with our tools at Visible. So if I click add to pipeline, I'm going to come and add it to Camterra here, and we'll just do that seed one we just created. And so now I have all of this data actually directly in my Visible account. So you can come in here and I have all my data now from Visible Connect in here. I can keep my own notes as we go and pitch Expo, and I can see any activity as it relates to things that are happening within my Visible account in Expo. So those are some free resources. The other thing is like removing data entry. I'm a geek when it comes to trying to automate as much as possible from this, right? It's a time-consuming process. You want to spend your time on high leverage things and not so much on data entry and like management of like the day-to-day of the fundraise. We built a Zapier integration for this. So this is just an example. You can create any kind of triggers you want. I just had one set up today for the Zapier button here in Chrome. I can say, hey, I want to trigger this and getting, oops, caps lock's on, getting intro to Corey. And I'll click send. And this is actually going to go and automatically add this to my pipeline in Visible. So if I go back now to, I think I had this one set up to my series A, and let me refresh. You can see now I have Concrete Ventures already set up. I got my notes here. That's like a little simple one I set up this morning, but you can use any triggers, Google Calendars, emails, what have you. You can automatically fill in. There's a template you can choose and use, but if you click this link, it'll take you to our integration with Zapier. One of the best things you can do, right, is getting intros. And who can make intros, to potential investors? You got mentors and advisors. Your current investor is a great source of intros. Fellow founders and peers, and then founders in the target investors portfolio. So maybe you think that, hey, there's a great fit. Who did they invest in? And maybe I can reach out to those founders on LinkedIn and just say like, hey, we'd love to get your opinion on so-and-so. Do you have 5 minutes to speak this week? Build a relationship with that founder and get an intro to the investor, because referring founders is a huge source of deal flow and really what VCs index for is like what founders are sending us other founders they think are high caliber. Some rules of thumb, like 5 to 10 people to make introductions, I think is the right number. And if you look at that Jenny Fielding thing, she has a great kind of a workflow for how you can do that. But I think the most important thing is also closing the loop with the person providing the intro. Whether it was a good intro or not, if you close a loop, you'll get way more interest, right? If you just ghost and don't say anything, great, I did an intro for Corey, never heard anything back. But if you close the loop, you're gonna be way more likely to get more intros because they know like, hey, yes, Mike's appreciative of my time. He's letting me know if it's a good fit or not. I can recalibrate of who I'm gonna intro Mike to. So getting intros, and sharing that pipeline document of like, hey, here are all the investors I think are a good fit. Who can you introduce me to? Who maybe is not on here that you think should be. So a really high leverage activity you can do. Cold outreach and your blurb. There's a template here you can download and use, but from what we found, you want to make it short as possible, like 50 to 200 characters. Your goal is not to get funded in your first email if you're reaching out cold or in the blurb. Your goal is to lead off with like the one thing that's great about the company. Maybe it's someone at the team, maybe it's traction you have, maybe it's something else. Maybe it's a demo of an amazing product, but keep it short, less than 280 characters, and use it, right? Cold email actually does work, but I think one of the things is that founders tend to write a very long-winded or wordy email, and then you just keep it short, very specific, and why it should be of interest to that investor. So we got a template you can download to help with that. But again, it's the goal here is to get them to respond. It's not to convince them to invest. There's a lot on storytelling, and really every fundraiser is a story, right? The story is, why should you invest in this company and why now, and the deck. There's a lot of content online. We could probably spend a whole hour just talking about the deck, but I did find this recently, so I added it in. This is from Stripe Atlas, and they have a firm that literally just does pitch decks for a living. And I think it was one of the more insightful articles I've ever read. So I'd highly encourage you to check this out. It gives some good examples of how to frame your pitch deck. But one of the things I love that they did is they called think in acts, not slides. Like the first act is like making your case. Like what are you building? What can it become? Why now? Second act is de-risking your approach. Like every time you're fundraising, what did you de-risk from the prior round? Was it product execution? Was it product market fit? Was it building out an executive team? Each raise, you want to show how you de-risk something for those next potential investors. And then act 3, kind of relating to the think big, operate in big markets, like broaden the case, like what does it mean to you, to the business, to the companies, if you go and do act 1. So definitely check that out. I love it. And the deck is certainly part of that. Take a quick thing of water. Great. All right, so stack your meetings. I think this is very, very key. There's a lot of good content here, but stacking your meetings when you're fundraising is how you can create FOMO and how you can create momentum and how you can get to a term sheet faster than if you were to kind of just casually fundraise. Because if you stack your meetings, and we'll get into some of the dynamics here, you're moving people through a pipeline and you're going to be building interest. And that is one reason for an investor to invest. So there's a great podcast with Elizabeth Ian from Hustle Fund. I think she has like some of the best tactical advice for raising a seed round that there is. Anything she puts out, I would certainly recommend reading or listening to. But again, we talked about the 5-month rule. Getting into how many meetings are you going to have? 30 to 60 meetings is probably the meeting answer we found. Like you're going to have 30 to 60 meetings with potential investors to get to maybe one yes. There's a great article here at the bottom, Anatomy of a Seed Round. This is a company that went through Y Combinator. Their round pretty much took them 5 months. They had 160 meetings, 40 different investors, not inventors, contributed to that round for $1.5 million. So that's a lot of meetings for a nice round, but not a huge one by any means. One of the things that Elizabeth Yin says is like, hey, if you've had 8 or 10 meetings and you haven't had any positive feedback or action yet, it's probably time to like reevaluate your raise. Is it something wrong with the business, the pitch, the deck? Because if you don't have any pickup, then you need to reevaluate or change your game plan. One of the things we did with Brett Broll, he's an investor in the Midwest in the States here. He talks about like on Sunday, getting all of our meetings set up for the next 2 weeks and reaching out to investors, getting intros and all of that, because that's how you're going to create FOMO. There's another great article from First Round called Fundraise Like a Surfer. I think this is a really, really great tactical advice too. They talk about putting potential investors into cohorts and moving like in a set and moving them through a process. They say like, hey, reach out to 5 firms at a time and maybe have 2 be like your top tier investors who you think are going to be the best fit for your business. And then have the rest be, maybe tier 2 or tier 3. And the reason for that is, you don't want, maybe you're getting feedback on how to change something in your business or on the deck or the pitch. You want to do that and not burn it on all of your top investors. But at the same time, you want to move people through a process. And it's always a delicate balance. So that's one of my favorite articles. Make sure to check it out. I think takeaway here is it's really running a process. Like you are fundraising and it is not something you're doing half the time. It's something you're doing all of the time. And if you stack your meetings, this is how you'll be able to build a lot of momentum in the business. Kind of related to this is that really relationship building and fundraising are hand in hand. Investors are not incentivized to invest into you at the first touch point. They're incentivized to wait, right? They can learn more about your company. And so really no one's probably going to write a check the first time they meet. They will invest if they don't think they have an opportunity to later on, right? If someone else is going to invest, that's what's going to get them to move. There's a really good little snippet here that you can click and listen to. This is Ezra Galston. He's one of the original investors in Cameo. He talks about how a founder pinged him just cold on DM and said, hey, can I get your thoughts about my company? Built a relationship with over the course of 6 months on Twitter and ended up investing in his business. And so relationship building is incredibly important because investors, there's an adage of, turn the dots into lines. And that's very much what's happening. Each time you meet with an investor, you're building rapport, a data point, a relationship, and you're turning something into a trend. Elizabeth Yin and the podcast we did with her, she gives us like kind of game theory breakdown. She says, hey, the first time you meet with a potential investor, you have this opportunity to invest or you can pass, right? And by default, most investors, they're best suited just to pass, right? I'm going to pass. I'm just going to wait because chances are I could probably invest at the same terms today as I could 3 months from now. So I'm going to pass, wait to see what happens with this company, with this business, with their fundraise. And then maybe 3 months later, I will invest. But again, I can probably get the same terms. So your job as a founder, right, is how do I remove that decision point from the tree of, I don't want 3 months of data, I want to invest today. And the way you do that is by running a process, having multiple investors interested, and generating that sense of FOMO. And again, it's always a balance, but generating that sense of FOMO in the round. Awesome. So one of the things that we always talk about Visible with our customers, and you hear from founders in our community and other folks outside of it, is that the biggest kind of parallel to investor relationships is a B2B SaaS funnel, in the sense that you kind of have leads, then you have you're nurturing people that might be a good fit, like marketing qualified leads, then you're fundraising, so you're kind of in this deal making, and then you have customer success. And you should really think about how to build relationships with those potential investors over time and treat them as a lead you need to nurture and then move through a pipeline. And one of the interesting things I found, this is Jason Lemkin from SaaStr. He says, yeah, you need to fundraise 365 days a year. Again, there's always the companies that don't need to do this, but he calls it a 1 in 30. He says that you need to spend 30 minutes a week keeping current sorry, Siri's speaking out. Keeping 30 minutes a week of your current investors up to date with going on, and then spending 1 hour each week building relationships with new investors. He says that your job after the seed round should be able to raise the Series A with 3 to 4 emails once you have the right metrics, because you've been building relationships with current investors as well as potential ones. And some data we found through our work at Visible is that companies who provide regular investor updates to their current investors are 300% more likely to get follow-on funding. And this really isn't that surprising when you kind of take a step back. But if your current investors are engaged, like you're just top of mind for those investors. And when other investors, downstream are saying they're doing diligence, they're going to contact your seed investors and say, hey, what's going on with this business? And they say, I don't know, or can't say anything great about it. That pretty much kills any fundraising activity you're going to have. And it's really important, and it's a huge signal if your initial investors are going to invest in later dates. So we're going to kind of update 101 and how you can use investor updates for Fundraise as well, even if you don't have current investors. We have a whole nother talk track about just investor updates and some of the interesting data behind it and other best practices. We do this every other week now, so you can click register. It's about 30 minutes, and we do it every other week. And it's a great content. You can walk away with about more investor updates. This can be like the quick one-on-one here about investor updates. So I think a couple quick things with investor updates and communication. Do it at the same time, every month or quarter or whatever that cadence is for you. Rough suggestion, like if you're just getting started in the formation phase, weekly I think is a good cadence. Then pre-seed to Series A, you go to monthly, and then Series B and later probably have a more formalized board reporting package that's going to go to quarterly. And another thing is like, hey, this makes your life easier. I always talk about like this as like a blog. Like the difficulty of writing your investor update is directly proportional to the time since the last one. So less amount of time, easier it is to write. Longer amount of time, harder it is. And one of the things you want to do every time you write one of these is keep things comparable. Every time you send out an investor update, whether that's qualitative or quantitative items you're sharing, don't cherry pick whatever happens to be the best thing, because investors will call that out right away. But also include absolute numbers, in addition to the percentages of growth, right? Growing 100% doesn't mean anything if you're going from 1 to 2. So I always say include absolute and the deltas between the periods, and don't happen to cherry pick whatever happens to be the best each period, because that's going to get called out, makes you look like an amateur. And again, it's not a good look. This is for just quick caveat for this, like always include cash burn and runway. This is for current investors. I would not share this data with potential ones, but with current investors, these are vitals. Regardless of what your business is, like these are the 3 things that I always tell you if you're alive, dead, or going to be dead anytime soon. And when you're sharing this type of information, current investors are going to be able to jump in and either help if something's going wrong, or help if things are going great and you can double down. But I always say include those 3 things to investors. Make things actionable as well when you're sending out an investor update. I think always include an ask section. So, hey, here's how you can help us. And because if you think about an investor, the only way an investor is successful is if the portfolio companies are. So theoretically, they should want to be helpful as possible to the portfolio companies. But one of the ways you can gamify this is give a thanks section right after that. So, hey, thanks to these people who helped us from last time. Oh, thanks to Corey for an introduction to XYZ person, or thanks to Mike. If you gamify it and investors see that other people are helping out, they're going to be way more likely to jump in. And I think being more specific is always better too. Like, hey, we'd love introductions to potential customers, or introductions to companies with 1,000 employees. That really could be anybody. So when you start to get more specific and get way more action, so like, hey, we'd love intros to VPs of marketing at companies with more than 1,000 employees in North America and CPG. Like, I can quickly understand, like, do I know anyone that fits that? Just like you have an ideal investor profile, you kind of have ideal customer profiles and really pinpoint things when you're doing ask. And then use it to fundraise. I think this is huge. Again, how you can use investor updates to drive FOMO, create momentum in your fundraising process, and get things done faster. This is Dom. He's one of our customers from Fast. And he kind of has this playbook, but he basically just says, like, as soon as you launch a company, he is like, I wasn't an insider. I didn't have a lot of warm intros. I started an investor update email. You put your progress at the top. You include your upcoming goals, things you want to accomplish. And then you reiterate what you did last month, especially when you said you did what you're going to do, right? Because an investor starts seeing that progress and you execute on, you said, hey, we're going to do X, Y, Z, or we're going to hit ABC. They're going to be way more confident to write that check because they know, like, hey, great. Once I have even more capital, I know they're going to do what they said they did. And now that they have like 3 or 4 months of data as you send these out, and then you go start fundraising, they see your ability to plan, to execute, you started to build a relationship, you started to connect those lines into dots, and can be a real game changer, especially if you're not highly connected or have a way to get a lot of warm intros. No investors, by the way, are going to say no to an investor update. If they do, they'll politely decline. But like, everyone loves understanding the progress of the business. And so I think this is a really great tactical way to help juice some momentum in a fundraise. Investing lines on dots, we talk about this all the time, but this is a great Mark Schuster blog post. I'll highlight that link that you can check out about how to think about building relationships with investors. And then if you need some inspiration, we have a whole template library. You don't even have to use Visible. You can just copy and paste. But we have a whole library of different things you could share, whether it's for a pre-seed raise, a Series A, to potential investors. So we have a whole library you can check out and use for your own company. And that also integrates with our product though as well. And again, we just really appreciate everyone's time. If you're a Concrete Ventures portfolio company, you actually get Visible Light for free. But if not, we would love to have you on board. It's as cheap as like $2 a month if you use Concrete 690 Founders First. And you'll be able to use our entire tool for the first 6 months as you get going. And yeah, feel free to email me anytime at mikeatvisible.vc. And if anyone has any questions, happy to stick around.
Thanks again, Mike. There was a lot of really good stuff in there. A lot of things that we could certainly appreciate as coming from the investment side. Folks, if you have any questions, feel free to ask them with the Q&A feature. We certainly still have some time left. Would love to answer some questions, but I have one to maybe kick us off, Mike. So I'm curious, like as a founder, how do you kind of balance the time between going down the fundraising path, which can be a full-time job on its own, and still running your business? Like how do you kind of find that balance?
I never personally, I've always struggled with it. I think it's really leaning on your co-founders, right? I think like CEO can be tasked with running the fundraise and leaning on your co-founders to be like, hey, we're going to be grinding for the next 3 or 4 or 5 months. And it's time for them to step up. They'll appreciate the chance to be leaders in the business. I mean, I'm sure they already are, but kind of be almost that CEO type person. But let CEO goes and fundraises. So that is a thing. Like people call it a distraction. I certainly think it is, but it also is a chance for you to go pitch your business, hopefully something you're excited about. But yeah, I think it's a time to lean on. And if you don't have co-founders, other people at your company, like, hey, I need you to take this, our business and be good stewards of it while we go and do this.
No, that makes a lot of sense. Looks like we have a question from Xavier here in the chat. So he's curious, like, so as a founder, how should you approach like a general fund versus industry specific funds? His example here was like ag tech.
Yeah, that's a great question. I'll have to get back to Xavier like on a better answer. My gut says there's probably no difference, but I think if there's an industry specific fund, you probably have a pretty good chance of reaching out cold to them if you're like right in their sweet spot. Like if you're doing ag tech, they do ag tech, reaching out to someone like, hey, we're an ag tech company. Here's why we're a great fit. My gut says that it's probably easier to reach out to someone who is vertical versus horizontal. Corey, do you have any suggestions for that one?
Yeah, I mean, yeah, to kind of your point, if there's a fit right out of the gate, you'll have a much better time getting in touch initially. Something I think about often is how much education are you going to have to do as the founder to the investor? If it's something that's completely not a fit, like if you're pitching, new drug discovery pharmaceuticals or deep tech to somebody who invests in kind of basically SaaS, how much are you going to have to educate them on the product to
Yeah.
get them interested? Because that's a huge time suck as well. I mean, if there's a reason why you really want them on the cap table, then it might be worth that time. But if not, you might be better focused on finding someone who gets your business and can kind of help out right away.
Yeah. Jeremy said, we're an early stage company, 8 months in and close to our first seed angel investment. Awesome, congratulations. Would you recommend an update email to a small group of mentors and key influencers who helped to this point? 100%. I think like communication to stakeholders, whether they're investors, to your team, to current investors, is an amazing one. It's a great way to show people like, thanks for helping us. But two, I think it's an easy way to stay top of mind. Like that's really the whole game with like, how do I stay top of mind? So if Jeremy's sending out an update once a month in email, and you're looking for key hires now that you've raised some funding, you're looking for introductions to customers who we think are a great fit, you're always going to be top of mind for that investor, because what are they doing? If they're not supporting core portfolio companies, they're talking potential hires, other potential investors downstream, meaning maybe if it's enterprise, like they know they have a big Rolodex. So I always think it's great to keep some level of a regular update. And then, I think it's always up to you. Like some founders are 100% transparent with everyone, and some elect not to share sensitive information with mentors. So maybe you don't want to share cash or cash burn. I think that's totally fine. You can create two separate versions, one that has all of the transparency in it, and then one that has, just the kind of high level stuff. Again, whatever you're comfortable with. Let's see here. We have a bunch coming through. Do you have any advice on approaching a corporate strategic for a later round as opposed to just traditional VC? I've never raised from a strategic investor. I would shy away from it personally. This is now, again, what I'm hearing secondhand, but usually it's going to take a longer time. And corporate VC is always changing, especially if they're investing off their own balance sheet, because every quarter things change, markets change, and you could be, they could even shut down the fund. And how are you going to get supported? So I always think like having a traditional venture investor is always incredibly helpful, because you're going to need them when you go and raise future rounds. And strategic VCs, this is like, take it for what it's worth at a point of one. From people that have them on their cap table, I don't think it's helped a whole lot. I think it sounds nice, but in reality, could be hit or miss depending on that. So again, I don't want to like sway you from not doing it, but like if you could round out a round with strategic folks, with a lead investor, then I think it's great. Like let's say you're building something with like on top of Stripe, Slack and HubSpot, and you go and you get Concrete to lead the round, and then you get 100K checks from Slack, those funds. I think that's great if you're building on top of those platforms. What's your view on using an external team for the fundraise? The question's not only about introductions, it's more beyond that. Usually a red flag. If investors see a firm or consultant or not the CEO doing the fundraise, usually that's a big red flag. So I would avoid that. That said, like if people are helping you just like find the right investors and not doing like the day-to-day pitching and introductions and all that, I think it's good. But I think it's a big red flag. We're a small company with only our co-founders. My co-founder is technical. How do you recommend balancing raising versus business development? Shit, that's a hard one. I think it kind of depends on are you raising or you're not raising. Example would be if you go out to raise, people say, well, hey, we need to see some more sales traction, right? It sounds like you're probably in business development sales. That's probably that's like, hey, let's not raise right now. Let's go and sell and get some traction and do that. Or the other flip side of that could be like, hey, we're raising so we can go build out go-to-market sales team, what have you. But that's always like a delicate balance, but and you can certainly split your time doing it, but I think it's kind of one or the other typically. Have you seen video updates, and is there any benefit to quickly filming those? Yeah. You know, you read about all these different new types of mediums that come out. Like people are, you know, instead of pitch decks, are doing investment memos now. You know, there's all different types of ways people convey things. I think video is great, by the way. Like, it gives you a chance to humanize yourself. You can even do a quick demo of the product and put that in there. We even render video in investor updates on Visible. So I think it's whatever you know, what's going to make you look best. There's not one answer for all, but I definitely seen video updates, and I think they work really well, and it's something a little bit different. Sometimes harder to consume would be the knock on video, like investors or people on the go. Do they have a chance to put their headphones on and open up their phone or view it there, versus like opening something in text is a little bit easier. I think that's the knock on the video, but I think you could use it to supplement what you have. I use video, so I'm a fan of it, but I also use text alongside the video. Awesome.
No, those are some great questions. I think we kind of got through all of them.
Yeah.
So thanks again, Mike, for coming and doing this. Super appreciated. Folks, we're going to be sending out the recording of today's webinar along with the deck with all of those links and different resources that Mike had in there. So you'll get that in your inboxes soon.
Yeah, awesome. Thanks, everyone. Really appreciate the time. And again, shoot me an email if I didn't get to your question, and I'll get this over to Corey and share it out shortly.
Awesome. Thanks again, Mike. Enjoy the day, everyone.
Yep. Take care.